Welcome back to the Deep Dive. We're here to cut through that fire hose of market noise and really give you the synthesized insights you need. And this week, well, we got a specific request, a mandate really, a deep AI-powered look at the top gold ETFs. We're focusing right in on the closing data for that pretty wild week ending October 24th, 2025. Okay, so let's unpack this. This isn't just, looking at where things closed. We've got a serious stack of AI intelligence here. Our mission today, to weave together all these complex indicators, things like volume ratios, daily true value, moving average trends across all the big gold players, from GLD right down to some niche leverage stuff. And the big question we're trying to answer is this bullish gold run actually sustainable? Or, are these extreme valuations and volume spikes setting us up for some kind of nasty correction?
That's really the heart of it, isn't it? That tension. And to figure it out, we first need to get a handle on the metrics the AI is looking at. Because these aren't your standard technicals always. They're trying to capture market psychology, structural pressures too. So the foundation, that's the moving averages, the MAs. We've got the 200-day MA, that's for the big picture. The long-term structure, are the institutions bullish or bearish? And then the 200-hour MA, that gives us the immediate shorter-term trend momentum. If a fund is sitting above both, well, that's a pretty robust bullish trend.
Right, and then there's the AI's secret sauce, almost. Yeah, the daily true value. This is the AI estimating fair value based on daily patterns, right?
Yeah.
Telling us if something's overvalued or undervalued. Like, is the market stretching things or is there value?
Exactly. It's crucial context for valuation. And finally, we look at buyer-seller power. Now, this gets misinterpreted sometimes. It's not just about volume. It's about who controlled the price movement. So a daily seller up reading, for example, that means sellers were actually the main force while the price moved up. That's often a really clear sign of profit-taking, short-term selling against the bigger jam.
Okay. Selling at a strength.
Precisely. And conversely, buyer up means buyers were firmly in control, accumulating, pushing the price higher. We track that daily and for the whole week, too.
Got it. Okay, foundation laid. Let's dive into the first section. The major players, the trends, and the outlier.
Right.
So starting with the trend check, that 200 MA data,
Yeah.
it sounds like the AI found a pretty overwhelming consensus for the week ending October 24th.
Oh, definitely. The foundation is pretty solid, bullish. The vast majority of these funds we tracked, and we're talking the big ones, GLD, IAU, GLDM, SGLL, AAAU, even UGL, OUNZ, BIR, DBP, DGP, they're all trending above both their 200-day and their 200-hour moving averages.
Wow, okay. So structurally, things look strong.
Yeah, that signal's powerful. It suggests that any selling pressure we might see in the shorter-term data, well, it's happening inside a bigger, recognized uptrend.
That consistency seems key then. Whether the AI calls it M trend for the majors or N trend for others, the direction is basically up.
It is. It means, the market might pull back, sure, but anyone betting on a big long-term reversal right now, they're fighting some serious structural momentum.
So the implication is that these high prices, these premiums we're going to talk about, they're not just based on, hype.
Well, not just hype. They seem based on a sustained belief in gold going higher, at least according to that big 200-day MA picture.
Okay, let's drill down. The giants. GLD, the SPDR gold shares, versus IAU, the iShares gold ETF. GLD closed Friday at, $307.52. Huge volume, too, over 13 million shares.
Yep, and IAU, often liked for its lower price, closed at $77.31. Volume was pretty close, actually, around 11.6 million shares.
So a big price difference, similar volume interest. What about valuation?
This is where it gets interesting. Despite that nearly $300 price gap, the AI pegged them identically on valuation. Both GLD and IAU came in at 23% over value based on the daily time frame.
23%. Okay, hold on. Is that normal? Or is 23% overvalue flashing warning sign?
It's definitely high enough to be cautious. Think about it like, if a house is truly worth $500, but you pay over $600 just to get in, you're really banking on prices continuing to scream higher.
Right.
For the AI to flag the two biggest, most liquid physical gold ETFs at the exact same premium, that tells you the whole institutional physical gold space is basically in a bidding war right now.
But the volume tells slightly different stories, doesn't it? Hinting at where the energy is. GLD seemed a bit softer.
Yeah, GLD's activity was down a bit. Daily volume was 96% of the day before. Weekly was 95%. A little sluggish. Maybe the high price tag has something to do with it.
Whereas IAU?
IAU showed more momentum, more interest picking up. Daily volume 107%, weekly 113%. So it suggests the accumulation, the fresh money coming in, was maybe leaning a bit more towards IAU that week.
Could be the lower price making it easier to get in. Or maybe fee structures.
Could be either. Or specific liquidity needs for different desks. But bottom line, IAU had the better relative volume trend for the week.
And the buyer-seller power. You mentioned tension there. GLD was daily seller up, but weekly buyer up. How does that work?
Well, you reconcile it by thinking in two time frames. The weekly buyer up, that confirms that over the whole week, yeah, buyers were accumulating. But the daily seller up tells us traders were hitting the sell button right into the Friday close. Sellers were driving those last upward moves, but likely distributing shares, taking profits.
So strong week overall, but people getting nervous at the end.
Exactly. That set up strong weekly buying met with daily selling into the close. It's a classic little warning sign. Suggests the rally might be due for a pause, maybe a sharp pullback, before the longer trend tries to resume.
And IAU, what was its dynamic?
IAU was slightly different. It showed daily buyer Dan power against that same weekly buyer up.
Buyer band, so buyers were in control, but losing steam as the price ticked down.
Kind of, yeah. Buyers were dominant on the day, but maybe struggling a bit more as they pushed into resistance or sellers. So, the takeaway for both giants, weekly accumulation was there, but signs of exhaustion or distribution popped up right at Friday's close. That 23% premium is likely making traders itchy.
Okay, makes sense. Now let's talk about the complete opposite picture. The outlier. GLL. The ProShares Ultra Short Gold ETF. This thing is built to go down when gold goes up.
That's one. And GLL's data, it's basically the market's anxiety written down in numbers. While everything else is structurally bullish, GLL is definitively below both its 200-day and 200-hour moving averages. Confirms its bearish structure relative to gold, which, yeah, is exactly what you'd expect while gold's rallying.
But that valuation, that's where it gets really weird.
It really is. GLL is the only fund in our list that's undervalued, and not just by a little bit, by a massive 52%.
52% undervalued, so it's incredibly cheap relative to where the AI thinks it should be.
Ridiculously cheap. It suggests the market, or at least a part of it, thinks this gold rally is way overdone. And if gold does pull back hard, GLL is positioned for a potentially huge snapback from these super discounted levels.
And the volume numbers seem to back that up.
They do.
People piling in even though it's trending down.
Absolutely.
Yeah.
GLL saw this huge volume surge, 180% of the previous day's volume, 129% of the previous week's. That's not just casual hedging. That feels like a stampede.
Wow.
Yeah, that kind of frantic buying into an inverse product, it usually implies one thing. A significant chunk of the market, probably aggressive traders or hedge funds, are betting big on a sharp, imminent gold correction. They're willing to buy something 52% undervalued and pour money in, basically betting that 23% premium on GLD and IAU just can't hold.
And it gapped up too.
Yep. GLO was one of only two things, the other being gold futures, to actually record a gap up at the open that week.
A gap up on a short fund means strong buying interest right away.
Exactly. Suggests that even overnight, the worry, the desire to short gold or hedge, it was strong. So you put it all together. Deep undervaluation, massive volume surge, a gap up. GLL looks like the purest measure of volatility expectation for that week. Tells us that while the main trend is up, fear is building underneath.
Okay, let's broaden out again. Section 2. Volume anomalies and that daily true value across the board.
Right, let's look at that valuation stretch systemically.
We know the main cluster is around 23%. Overvalue, GLD, IAU, GLDM, SGOL, AAU, OUNZ, BOR. That's sort of the baseline premium for physical gold right now.
That's the price of admission, yeah.
Yeah.
But when you look at the leverage stuff, the derivatives, that's where the market really stretches. The extremes show just how hot things got. You see UGL, the ProShares Ultra Gold, the leveraged long one, that's sitting at 42% overvalue, nearly double the premium of the physical stuff underneath.
So people are paying a huge premium for that extra bullish kick.
They are. And then you look at gold futures, the GCZ25 contract, that's showing an absolutely massive 55% overvalue.
55% on futures? Wow.
Yeah, the futures market, which kind of leads short-term pricing, when it's running that hot, it suggests either crazy demand or maybe high systemic risk being priced into those contracts.
Okay, what else stood out?
Well, DGP, the DB Gold Double Long ETN, was also high at 43% overvalue, similar to UGL. But the most, let's say, alarming valuation, that belongs to DCZ, the DB Gold Double Short ETN.
The short one again. What was its number?
This short note, designed to fall when gold rises, was trading at an incredible 136% overvalue.
Wait, 136% overvalue? On a short instrument? How was that even possible? That sounds broken.
It is a massive, massive red flag. It suggests something's really wrong structurally. How does it happen? The price is just wildly disconnected from its supposed value. It almost certainly points to intense pressure, maybe forced short covering on a massive scale, or some kind of structural issue within the ETN itself, like a huge redemption forcing the remaining shares to trade at this insane premium because there's just no sellers left, or very few. We need to connect this to volume.
Okay, let's do that. Section 2.2, extreme volume ratios. Where was the frenzy? You mentioned DZZ.
Right, DZZ isn't just a valuation outlier, it's ground zero for a volume explosion. This really backs up that structural problem theory. DZZ showed, get this, 902% of the previous week's volume.
900%, 9 times the normal weekly volume.
9 times. So you pair a 902% volume surge with a 136% overvalue premium. The story seems pretty clear. A massive, probably forced liquidation or maybe a huge buy-in was happening in that specific short note. That's not normal trading. That's a market scrambling to fix a major imbalance or get out of positions, seemingly at almost any price.
That 902% is just hard to wrap your head around. Were there other big volume spikes?
There were. DBP, the Invesco DB Precious Metals ETF, that saw 264% of the previous day's volume. So a sudden burst of interest there, maybe people diversifying slightly beyond just gold within precious metals.
Okay. And any laggards on volume? Anything notably quiet?
Yeah, one stood out on the low side. DGP, the double long ETN, its daily volume was only 37% of the day before. Really quiet. And that one was 43% over value, you said?
Exactly. So here you have this leveraged long product already trading at a hefty 43% premium, but the interest just seemed to evaporate into the close. Low volume plus a high premium, that makes it really vulnerable to a sharp drop if sentiment shifts.
Right. Thin market, high price, dangerous combo.
Okay. We've hit some pretty wild numbers here. Huge premiums, explosive volume in certain pockets. It really highlights where the market's energy, maybe even its anxiety, was focused.
Absolutely. The data's almost screaming and gold's running hot, especially in those derivative and short-term products.
So if you're finding these kinds of deep insights valuable, the synthesis, the AI interpretation you don't typically get elsewhere, definitely make sure you hit that follow button.
Yeah, and turn on notifications too, so you get our market analysis update first thing every week. Don't miss out.
Okay, moving on. Let's look at unusual activity and squeeze metrics. Did the AI flag weirdness across the board, or just in those pockets like DZZ?
No, it was pretty widespread. The analysis flagged unusual activity on 10 out of the 14 symbols we tracked.
10 out of 14, so most of them.
Yeah, a high correlation. It confirms this wasn't just a steady climb kind of week. The whole gold complex felt energized, non-standard trading patterns, which fits perfectly with the extreme volume and valuation numbers we just saw.
Right. Now, with DZZ having that insane volume on the short side, did the AI actually detect a squeeze? Because that sounds like squeeze conditions.
That's what's so interesting. What we didn't see, the analysis showed no explicit flags for daily squeeze or 1-hour squeeze on any of the symbols.
Huh. That seems counterintuitive. Massive volume in a short product, 136% overvalued, but no technical squeeze. How does that happen?
It probably suggests that while the pressure was absolutely immense, like you said, likely forced covering or liquidation, in DZZ's case, the overall market, or maybe the structure of that specific ETN, had just enough liquidity to absorb those trades without triggering the rapid, uncontrolled price explosion that usually defines a technical squeeze flag. So the pressure cooker was definitely on high, but maybe the lid didn't blow off in that very specific squeeze pattern the AI looks for. It was more like absorbed chaos, maybe, even with that crazy volume. It's a subtle but important distinction for risk assessment.
Okay, subtle but critical.
Yeah.
Let's move to the final section. Buyer-seller power and those opening gaps. This gets into the immediate momentum, right?
Exactly.
Wow.
We know the long-term trend is up. We know things got stretched valuation-wise. Now, how did the market actually behave day-to-day, especially at the close and open? This is where that conflict really shows up.
You mentioned strong weekly accumulation. Overwhelmingly strong. 12 of the 14 symbols finished the week with weekly buyer-up power. That's the foundation. Buyers were in charge over the 5 days, driving prices up. Includes the ones, GLD, IAU, even the futures contract.
Okay, weekly picture, buyers win. But the daily close.
The daily close tells a very different story. Caution, retreat almost. 7 symbols, including a lot of the core holdings again, GLD, SGOL, AAU, gold futures, DBP, DGZ, DGP, they all showed seller up power on the daily time frame.
Seller up again. So sellers driving prices higher into the close, distributing shares.
That's the absolute core contradiction for anyone trading this right now. Weekly buyer up says institutions are likely adding long-term positions. Daily seller up says those same players, or maybe faster money, are using those higher prices driven by the weekly trend to sell shares right into Friday's bell. Textbook profit-taking.
So if you're listening, how do you trade that? Which signal matters more, the weekly strength or the daily selling? Well, you have to respect the daily warning, but keep it in the context of that weekly trend. The fact that daily seller up was so widespread, especially with gold already at that 23% premium, it signals pretty significant short-term correction risk. It tells you traders are seeing these high prices, the overvalue, as a good spot to take some chips off the table, probably knowing the longer-term 200 MA trend is still okay underneath. It feels like a tactical pause is likely, maybe some volatility, rather than a full-blown trend reversal yet.
So expect chop, maybe a dip, but the bigger picture might hold.
That's what this specific data point suggests, yeah. Oh, and the only symbol showing pure buying strength, daily and weekly.
Let me guess, DZZ.
You got it. DZZ, the double short ETN, it had buyer up power on both timeframes.
Which just reinforces that whole crisis situation we talked about. Buyers were desperately pushing its price up, totally disconnected from gold itself.
Exactly. Confirms the 136% overvalue and the 902% volume were driven by frantic buying, whatever the underlying cause was.
Okay, last piece of the puzzle, the open gaps. How did things open each day relative to the previous close? Gives us a clue about overnight sentiment.
And the clue was pretty consistently negative, actually, pessimistic. Out of the 14 symbols, 8 of them recorded a clear gap DN, a gap down.
Gapping down, meaning they opened lower than they closed the day before.
Consistently. And crucially, this included all the major physical gold ETFs, GLD, IAU, GLDM, SGOL, AAU, UGL, OUNZ, all gapping down.
But wait, if the weekly trend is strong, weekly accumulation is strong, why would the main ETFs keep gapping down in the open?
It's likely the market's reaction to that high valuation stretch we keep mentioning. Those gap downs suggest there was persistent selling pressure overnight, or maybe sophisticated traders just aggressively selling off positions right at the open, refusing to hold that 23% premium risk when the market wasn't trading.
So they're happy to chase it during the day, but nervous about holding it overnight or into the open.
That's what it looks like. It tells you the bullishness has conditions attached. They'll play the momentum game, but they keep trimming exposure because of that overvalue premium.
Were there any exceptions? Anything gap up?
Only 2. GLL, the short ETF, which makes sense as people position for a drop. And interestingly, gold futures GCZ25.
Ah, the futures gapping up fits with their huge 55% overvalue, right?
Yeah.
Suggests maybe global sentiment was stronger than domestic ETF caution.
That's a plausible read, yeah. Global macro players pushing futures higher overnight, even while U.S. ETF traders were maybe getting a bit more cautious with the physical proxies gapping down.
Okay, a lot to digest there. Let's try and synthesize this. What are the main takeaways from the AI analysis for that week?
Okay, summing it up for the week ending October 24th. The AI really reveals a market that's fundamentally strong, but tactically very stretched. There are 3 big tensions that define the risk going forward. First, long-term strength versus short-term pressure. No doubt the 200 MA data shows gold is structurally bullish, but that widespread sell-up daily power and all those gap downs, that signals short-term distribution and profit-taking are really steering the ship in the immediate term.
Strength underneath, but weakness on the surface day to day.
Pretty much. Second tension, valuation stretch and distortion. The main funds are running hot at 23% overvalue, which is already a caution flag. But it gets way more extreme in the fringes. Futures at 55% over, and that frankly broken-looking DZZ short note at 136% overvalue. That premium is built up, and markets usually find a way to release that pressure.
Right, it feels like something has to give there.
And finally, the third tension, volume extremes as anxiety indicators. Yeah, GLD volume was a bit soft, but the huge relative volume we saw in IAU, in DBP, and especially that absolutely astronomical 902% weekly spike in the short DZZ, that confirms market energy wasn't calm. It was focused on hedging, maybe forced repositioning, and generally bracing for volatility.
Okay, so strong foundation, but stretched valuations, weird volume spikes, and daily selling pressure. Which brings us to our final provocative thought for you, the listener. Given this widespread overvalue status, especially that core 23% and the strong seller-up momentum we saw daily, the question might not be if a correction is coming, but maybe how it plays out. Can gold work off that 23% premium with just a tactical dip without completely breaking that strong underlying 200 MA support? Or does the valuation stretch inevitably lead to a bigger reset? Something to definitely keep an eye on. And look, if the depth of this data, these AI-driven insights we shared today, if that was valuable for you, and we hope it was, you really don't want to miss our future analysis. We do this deep dive every single week.
Yeah, definitely hit that follow button, turn on the notifications. That way, you'll be the first to get our next detailed market breakdown next week.
Absolutely. And thanks to you, the listener, for giving us the material for this really crucial deep dive today. We're looking forward to hearing what you think about these extreme readings.